All right, let's get right into it. I want you to think about your business's financials, but not as some boring old spreadsheet. No, think of it like a story. You've got this rich, ongoing history, and then you have these exciting, action-packed yearly chapters. Today, we're going to break down the two different kinds of accounts that tell that whole story. So, let me ask you this, just to get us started. When you look at your business's value, what are you really seeing? Is it just a quick snapshot of what happened this year? Or is it more like a long, unfolding story? The thing is, it's actually both, and you absolutely have to know which is which. And this is where our two main characters enter the scene. See, in accounting, you've got two main types of accounts. On one side, you have your permanent accounts. Think of these as the ongoing story, the big biography of your business that just keeps going year after year. And on the other side, you've got the temporary accounts. These are like the individual chapters, They tell the story of what happened in one specific year.
All right, so let's start with the foundation. We're talking about the big overarching story here. These are your permanent accounts.
So what makes a permanent account, well, permanent? The key phrase to remember is carry their balance forward. These accounts just never reset. They keep a cumulative, ongoing record of where your business stands financially. It's basically the running total of your business's entire life. Okay, so where do these permanent accounts actually live? You'll find them right on the balance sheet, and they come in three main flavors. First, you've got your asset accounts. That's all the stuff your business owns, like cash or inventory. Then you have liability accounts. That's what you owe, like loans. And finally, there's equity. Think of equity as the business's net worth, right? It's what's left for the owners. And a big part of that is an account you'll hear a lot about called retained earnings. Let's make this super concrete with a simple example. Imagine your business finishes year one with, say, $80,000 in the bank. That's your cash balance on the very last day of the year, December 31st. Now, because your cash account is a permanent one, what happens when the clock strikes midnight and we flip into year two? Nothing. That $80,000 just rolls right over. You start the new year with the exact same amount. The story just picks up right where it left off. Pretty simple, right? Okay, so that's one half of the story. Now let's talk about the other half. If the permanent accounts are the long biography, the temporary accounts, well, they're the action-packed yearly chapters. They give you that crucial snapshot of performance for a specific period. So, unlike their permanent cousins, these guys have a really short lifespan. They're designed to do one job: track all the financial action for a single period. Could be a year, a quarter, whatever. And here's the absolute key difference. At the end of that period, they get closed out. Poof, they're reset right back to zero. So the life of a temporary account is really simple. For 1 year, it's just busy tracking everything. It tracks all the money coming in, your revenues, your sales, and it tracks all the money going out, your expenses, like rent and salaries. And then, when the year's over, that's it. The balance is cleared out and it's reset to zero, all ready to start a brand new chapter. Let me give you an example. Let's say you earn $50,000 in sales this year. That 50 grand gets recorded in a temporary revenue account. It's the story of this year's sales and this year's alone. But wait a minute, if the account gets zeroed out, that money doesn't just vanish into thin air, right? So where does it actually go? And that brings us to the most exciting part of the story. This is the climax, where the yearly chapter ends. It's a process accountants call closing the books, and it's exactly how the plot of this year's chapter ends up updating the main biography of the business. So here's what happens. At the end of the year, you take all the temporary accounts, all that revenue, all those expenses, and you basically write a summary for the chapter. Did you make a profit or did you take a loss? And that summary, that final number, gets transferred over to a permanent account. Which one? Usually it's retained earnings. And remember, that's a permanent equity account that tells the ongoing story of the business's value. Okay, so you might be thinking, why? Why go through all this trouble? Why not just have one type of account? Well, the reason is that this distinction isn't just some random accounting rule. It is absolutely fundamental to getting an accurate picture of your business. So what's the moral of our story? It really boils down to three things. First, by separating these accounts, you get a crystal clear view of your long-term value versus your short-term performance. Second, it makes sure you're not mixing up last year's sales with this year's numbers. You have to keep those separate for any real analysis. And finally, it just hits the reset button, getting everything clean and ready for the next financial year. So let's just put this all side by side one last time. You've got your permanent accounts, they live on the balance sheet and they tell the continuous, ongoing story of your business's financial position. Then you have your temporary accounts, they make up your income statement, and they tell the story of just one period, one chapter before they get reset to start all over again.